Zomato is up more than 120% from the lows of February 23. If you're an investor in Zomato, an obvious question in your mind would be, should I book profits or is there more potential in the stock? Ideally, you would think that it's the right time to exit. If you're not an investor in Zomato, you may be wondering whether the stock is currently overvalued and too expensive to enter. But our research indicates that there's a lot more potential that is still unaccounted for. Before we tell you why, let's understand what Zomato does first. It basically connects foodies with restaurants. Key components to this business are the foodie, the restaurant, and the delivery partner. Along with its main business, Zomato also owns Blinkit, a grocery delivery service, and Hyperpure, which delivers fresh ingredients from the farm to the restaurants. To add on to that, they also host a food carnival called Zomatoland. It would be fair to say that they're trying to create a niche ecosystem of services. When its IPO launched in 2021, the shares opened at a 52.6% premium over the IPO price. The rally continued as it touched its then all-time high of Rs 169 in November 2021. But the stock took a 74% nosedive to Rs 41 in just 8 months because Zomato reported an 80% increase in net loss in FY22. Its EBITDA loss was also higher at Rs 1,844 crore as compared to Rs 467 crore in FY21. As if this wasn't enough, Tiger Global Management LLC and Uber Technologies divested their stake in Zomato. But none of this slowed down Zomato, and it quickly turned its revenue around, growing by 68% in the subsequent year on the back of increasing order values. In August 2023, it finally turned EBITDA profitable. It was a huge moment not just for Zomato but for the entire Indian startup ecosystem. The stock has been on an upward journey since then. But how did this sudden turnaround happen? The key reasons for its growth spurt are Blinkit's and Hyperpure's revenue contribution, rationalization of media budgets, and cost cutting in variable costs, and a sequential increase in gross order value, which means that they can take care of their overheads and still deliver. And let's not forget about these additional revenue streams over the years too. Our research team's analysis suggests that the food aggregator space is still nascent. There is enough room for revenue growth in the medium term without expanding geographical footprint further. By our estimates, the Gold users order from Zomato about 9 times a month. The next tranche of users, whom we classified as regular users, which is non-Gold, order from Zomato about 2.7 times a month. This ordering frequency, in our view, increases the probability that regular non-Gold users could graduate to Gold membership. Given the outlook of sharp profitability improvement in all 3 businesses of Zomato, we believe valuations for the stock are now pretty sensible. We therefore think that there is enough room for meaningful re-rating of the stock. In fact, at current market price, Zomato looks attractively valued as compared to many global and Indian peers on profit multiples. We see the stock trading at Rs 200 per share in our bull case scenario and Rs 70 in our bear case scenario, implying a risk-reward skew of 2.6:1 towards the upside. Slowdown in discretionary spending, negative external factors disrupting business operations are some of the key risks. Overall, from the company's financial standpoint, these are our key takeaways. According to this analyst, the Cricket World Cup is also likely to help boost revenue for Zomato, while another says that the new generation of digital natives and their rising income will add to the robust industry tailwinds. Okay, that's all for now. I'm off to Zomatoland.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.